Now, you've probably seen Jim Chalmers on TV lately with that big grin telling everyone the good news. Australia's economy is growing. Now, it's up 2.1% over the year, up 0.4% in the last quarter. We're apparently one of the better performing economies in the world. It sounds great, right? But let me ask you something straight away. When you hear the economy is growing, do you feel that in your own household? Do you feel 2% better off? Do your savings feel 2% healthier? Do your groceries feel 2% cheaper? Because I look at these numbers, then I look at what's actually happening to Aussie households and I see two completely different realities. On paper, the economy is doing well. But when you turn past page 1, when you dig into what is actually driving this growth, the whole story changes. So in this video, I'm going to show you in simple language what this 2.1% growth actually is, what's really driving it under the surface, whether Aussie households are actually better off, and what this all means for 2026 in terms of inflation, interest rates, and the property market. Let's unpack it, let's get into it. Let's start with the headline numbers Jim is so excited about. The latest national accounts say the economy grew 2.1% over the year, about 0.4% in the September quarter. That's the fastest annual growth in roughly 2 years. Treasury and a lot of economists are calling that a positive, promising result. It kind of looks like the story is the downturn's behind us, growth is back, and the recovery is on. And if you only read page 1 of that story, you'd think, okay, we're doing all right, crisis over. But page 1 never tells you who is actually doing well. So let's talk about where this growth is actually coming from. Okay, on the surface, there are two big engines pushing GDP higher. The first one is business investment. So the data center boom businesses have finally opened the wallet again. Private investment jumped almost 3% in the quarter, and a big chunk of that was spending on machinery and equipment. There's been a huge investment in data centers in New South Wales and Victoria to feed the AI and cloud boom. That is generally positive for the long term. It boosts capacity, productivity, tech infrastructure, and jobs in those sectors. So yes, one part of the story is the private sector is starting to drive growth again. So the second engine is household spending. The numbers say households are spending more, but let's be honest about what that actually means. Most of the extra money went to electricity and gas, rents, insurance, food, health costs after a really nasty flu season. So technically, yes, consumption is up, but it's not because everyone's feeling rich and confident. It's because the basics of life actually do cost more. And while essential spending went up, discretionary spending, the stuff you choose, actually went down. So the growth story so far is businesses are investing in big projects like data centers. Households are spending more on power, rent, food, and insurance. Now let's turn the page and see what's really happening underneath. Okay, so let's look at the next part of this. So this is where the feel-good story starts to actually fall apart. GDP per person. Now, the pie is bigger, the overall economy is bigger, but your slice isn't. Yes, total GDP is up 2.1%. We have a bigger economy. But once you divide it by our fast-growing population, the picture does change. On a per-person basis, GDP per capita was basically flat this quarter and only up about 0.4% over the year. So the economy is bigger, but the average slice of the pie hasn't really grown. That's why it doesn't feel like a boom in your household. Now let's talk about pay, real wages, what your income buys after inflation are back at 2011 levels and going backwards again in the most recent quarter. Why is this happening? Because in the September quarter, headline inflation jumped about 1.3% for the quarter. Wages only grew about 0.8%. So prices are growing faster than wages. Economists and even the RBA are basically saying real wages are likely to go backwards again in 2026 if inflation stays sticky. In other words, your pay packet might look a little bigger on paper, but what you can actually buy with it is shrinking. Inflation, it's still too high, still sticky. Inflation is rating at around 3.8% over the year. That is above the RBA's 2 to 3% target band, and it has started to re-accelerate, not fade away. And what's driving it? The same things you feel every week: power, insurance, rents, food, and overall services. We also can take a look at productivity. It's too weak to support real wage growth. Productivity, how much output we get for each hour worked, has barely moved. Over the year, there's been a small uptick, but it's still very weak. The RBA has basically said, without stronger productivity, you cannot have fast, real wage growth without reigniting inflation. Right now, we've got mediocre productivity, Real wages are going backwards. Inflation is running hot on essentials. That is not a sustainable, feel-good recovery like Jim Chalmers is trying to sell us. Okay, let's actually take a look at trade. First of all, net trade. This is exports minus imports. Actually dragged on GDP. Imports grew faster than exports. Big miners and LNG producers ran down stockpiles while doing maintenance. So trade is not saving us. If anything, it's pulling the headline number down, not up. Let's take a look at the cost of living in housing, the real world. On top of that, rents are at record highs. House prices have surged again this year. Construction costs are still around 40% higher than in 2019. Mortgage repayments are sitting at punishing levels after the last rate hike cycle. So let's line all of that up and just summarize where we're at. GDP headline does look strong, but per person or on a per capita basis, growth is basically flat. Real wages have actually gone back to 2011 levels. Our buying power is not increasing, it's going backwards. Inflation is still biting and putting upward pressure on interest rates. Trade is actually dragging the economy down, not providing a boost. And life is getting more expensive, not less. That's the part that never makes it into the press conference. So now I want you to put yourself in the RBA's chair for a second. They're looking at an economy that's growing just fast enough, inflation that's too high and lifting again, households still under pressure, businesses starting to invest and push demand higher, and their conclusion, they say the economy might be running at its speed limit. If growth stays at this pace without a big improvement in productivity, the RBA worries inflation will stay too sticky for too long, which is why rate cuts are basically now off the table. Markets are now actively pricing in a real chance of a rate hike in 2026. So while politicians are pointing at the 2.1% number and smiling, the RBA is sitting there thinking, if this keeps up, we may need to tighten again. For households, that's the real risk because any extra rate rise lands straight on your mortgage repayments, property investor holding costs, and ultimately rents and housing pressures. So what does this ultimately mean for you? So let's translate all of this into plain English for 2026 for you. The economy is not falling apart, but the growth is being driven by big business investment in data centers, households being forced to spend more on essentials, per person or per capita living standards are basically barely moving ahead, real wages or your buying power is back at 2011 levels and it's starting to slip again. Inflation is still too high with upward pressure on interest rates. The RBA is more worried about fighting inflation than about cutting your mortgage rate. And there is a genuine risk that rates stay higher for longer or even go up again. So when you see the Treasurer celebrating, you're absolutely right to ask, but what does this actually mean for me and my household? Because right now, the story of the Australian economy is this. The headline looks okay, but at an individual level, at a household level, it still feels like a grind. So what is the main outtake for property investors or anyone looking at the property market? What does this mean for the forecast of the property market? Okay, overall, some good numbers for the economy, individual households not doing that great. However, where the economy is at right now, this lays a very strong foundation for continued house price growth. This is not an economy which is doing exceptionally well. This is not an economy which is delivering incredible advances in terms of your standard of living and your buying power. It is not doing that. But this is an economy which is slowly moving ahead, very low unemployment. And when you add in high levels of immigration and population growth and a bottleneck on new supply of property, this is an economy which will deliver for us 6, 7, 8% annualized house price growth. Now, one of the biggest research companies in Australia, SQM Research, they said with an economy behaving just like it is, like the numbers say, they predicted house price growth in 2026 of 10% for that year. So make no mistake about it, this is an economy which sets house prices up for continued house price growth. Not such a great story for individuals or households. If you want to see the full video on SQM and SQM's report, you can go ahead and click that video and get all that information right now. So tell me in the comments, do these strong economy headlines match what you're seeing in your own life? Do you feel like you're part of this recovery or watching it from the outside? As always, this is your daily property update, your 3 to 7 minute breakdown on the property market so that you can become a property insider and make smarter investment moves. Hit like and hit subscribe so you never miss a video.